Can I ask you to introduce yourself briefly?
Sure. My name's Ellis. I'm the CEO of Man Group, which is, I guess for the purposes of this, the world's largest listed hedge fund business, and been around amazingly for 240 years, but not always as a asset management business. And we are certainly in Europe the largest quant investor there is, I think.
Thank you.
Okay, my name is Ryan Blute. I am the head of Europe for PIMCO. PIMCO is probably the world's largest active fixed income manager. So we manage just bonds, about $1.7 trillion worth of bonds.
If it's not Alberto. You, it's the Chinese.
Right. Yes.
Alberto Gallo. I run the macro fund at Algebris Investments. We have 15 billion across equity, credit, macro, and private debt strategies.
Okay, thank you very much. Luke, I would like to start with you. In the speech by Lasse, he was highlighting the possible role for active management for not being passive, but in a very particular way. So the idea is that you need to be active. The market needs active investors in order to identify profitable investment opportunities. Now, you are a manager of a quant fund that does active management, but in a very different way. So you try to identify, or at least to some extent, try to identify trends, which relies on the idea that markets are predictable in a sort of a traditional sense based on information on price history. So what is your view about the debate about market efficiency and predictability from your viewpoint?
I think that the idea of the market as a zero-sum game and an efficient market requires one to have an unbelievably sort of meta-level view of it, to think of it over all time and all securities, which is not in the end how anybody actually invests. In the real world of investing, securities or FX or anything else takes time to adjust to information. And in essence, that is the thing that you're taking advantage of with trend following, which is one of the things we do. And in essence, what you're doing, the answer is, when there's a new piece of information, if every investor in the world was equally well informed and had exactly an instantaneous adjustment mechanism, prices would adjust instantaneously. The reality is you have some people who are staring at a screen and trading in microseconds now, and you have some people who have quarterly or even annual investment committees, and they make changes and decisions to change their asset allocation or their investment decisions over a much longer period. The trend following is in essence taking advantage of the fact that there is this behavioral effect, that it takes people a different period of time, and what we're doing is encouraging assets to get to their fair value quicker. So actually we make the market more efficient by our activity, but it still doesn't become efficient. Right.
So I looked in details the performance of CTA funds in the last 20 years. And it's quite remarkable how the performance has almost continuously deteriorated until very recently. And the very last period is actually quite doesn't look particularly good. Do you see this, do you interpret this as evidence of what you just said, that perhaps this is due to the fact that this is a market becoming more efficient because of active investors like you, or is this a temporary effect due to, for instance, intervention of central banks or other exogenous shocks and factors, and you're going to start making money again?
So while I'm entirely not going to talk about our own funds here, but not all CTAs have had a difficult time. Some have been making money quite happily. You can see somebody afterwards to get some names, or a name anyway. Look, it's very clear that as information has become more readily available in all spheres of life, things have become more efficient. It is harder, whether it's trend following or stock picking or any other sort of investing, you definitely have to work harder to make the same amount of return today as you did 10 years ago and 20 years ago and 30 years ago. The good thing against that is it's amazing how many more things you can trade today that you couldn't have even dreamt about trading 20 years ago. So we trade the price of the electricity that lights this room. 20 years ago, the idea you might trade that as a financial instrument was, I mean, honestly, nobody had even dreamt of the idea. And that markets are actually much more liquid today. There's a lot of misinformation about that, I believe, but markets are very liquid, so you can trade very big size today, which means you could take advantage of certain effects. Clearly, one of the other things that happened, I mean, I would completely agree with Essie that there are a lot of people in the asset management industry who don't justify their fees. Given the success of CTAs, you have you've gone from there being 20 or 30 years ago, or 25 years ago, I guess, to there being several hundred today, and not all of those have the same quality. You know, it's interesting that almost all of the largest ones remain people who've been doing it for 20 years, because it turns out you do have to get better every day to keep up. That makes sense.
Thank you. Alberto, so you're coming from a very different viewpoint, I think, if I can anticipate it from Lasse. You know, in his speech, he talked about efficiently inefficient market, but at the end, the suggestion is the existence of an interior equilibrium where there could be deviations of prices from fundamentals, but that deviations can only be limited. Now, I kept on reading your letters from your fund, and my understanding is that you have a very different radical view, suggesting that actually there are bubbles where the deviations can be very large, and your suggestion in your last letter is that actually we are in the middle of one of that. Why? How did you justify that? I understand that you prepare some slides, so let me give you the clicker.
Thank you. So history tells us that markets are not always efficient, and there's a few reasons why. One of them is that there are frictions, there are costs for people to go out in the market, set up shop, and go and trade and arb inefficiencies at a micro level. Another one is that markets can be inefficient for a long time if there are large agents which distort prices that have unlimited firepower, like central banks. Or even if they don't do that directly, they can create a boundary of prices below which they say that they will come out and buy. This, you know, the so-called Fed put, which was effectively created by Greenspan and persisted with forward guidance over time. First with qualitative forward guidance, then data-based forward guidance. And finally, one other thing which is not in the assumptions for market efficiency is reflexivity. So we assume that the market is an isolated entity outside of the economy, but in reality we know that the market has an impact on the economy. And we know this very well after the financial crisis. So in a market where price appreciation continues because of these agents with unlimited firepower, sometimes inefficiencies can perpetuate over time. And this changes until there is what market participants call a change of regime. This is not about micro efficiency, but it's a distortion in all asset prices. So we can think of a link between QE and the price of risk and the volatility of risk. If you assume that QE pushes, and this is one of the desired effects from the policymakers, pushes people to take more risk, pushes people to search for yield, because by lowering the risk-free rates, you have investors needing to find other things. Now, when you go to school, they teach you not to, generally they teach you not to divide things from zero. If you divide things, asset prices or discount cash flows from zero, you end up with very high prices. Now, once your risk-free rate goes to zero or negative, you, as an asset manager, you need to pay for electricity, and that's not in the Sharpe model. You have a minimum amount of AUM fees that can keep you alive. So you have to take more risk. And you go into other asset classes. You go into investment grade, into high yield bonds, and finally you go into the risk of assets. You go and bet on volatility, compressing volatility, or credit spreads, which are volatility of default risk. So today we have a situation where not only asset prices are very elevated, but also the volatility and the risk premium in options is very low, and the amount of passive strategies has increased massively compared to where we were before. And all these things, to some extent, have happened together with low interest rates and quantitative easing. The question is, what will happen if one day quantitative easing gradually disappears? Will the market gradually go back to a new equilibrium, or will there be a change of regime, and what we're living now will appear as a QE inflated bubble? I'm in the second camp.
What is Ryan? What is?
Yeah, I think we are. So at our firm, we're probably somewhere in between these two. So we think there are some more secular reasons in why bond yields can stay low, and that you've got aging demographics in the wealthier societies, a lower, longer-term growth rate potentials out of developed world countries. And so those are some factors, and you've got an excess of savings over investment demand for long-term capital projects. So there are some things which we think will suppress interest rates longer term. However, when it comes time to buying securities and picking what we think will do better than the market, we get nervous as well about a world in which you could have a negative yield on a European high-yield bond, which we've seen before, and in a world where dividend yields on Vodafone might be 2 or 3 times higher than the bond yield on Vodafone. And so there's a lot of weird distortions that you're seeing in the marketplace, and it is impacted by these non-economic agents, we think. So you have central banks buying corporate bonds, buying equities in Japan. And so that we think that does distort prices, and it makes us quite nervous because you've had a 10-year run almost in which just buying riskier beta was the most profitable thing you could do, and you haven't had a default cycle occur. You've had central banks suppressing volatility, both economic volatility and financial market volatility. So, I mean, we agree with him that it's probably time to maybe dial down risk a little bit because you're not getting really paid a sufficient risk premium today.
Mm-hmm. Now, there are two ways of listening to you, Alberto. One is thinking that there is a dynamics in asset prices and maybe a smooth change in regime, which seems to be quite gradual if one were to look at the behavior of central banks. But you are, in your documents, you talk about bubbles, which suggest something very different. And we know that there is a long history of people that have called for lots of bubbles in the past that never burst. There is a famous joke about somebody who predicted 9 of the last 5 bubbles. So are you comfortable on that seat? And would you like us to call you back in 2 or 3 years?
Well, I think there is clearly a difference between overvalued assets and
right.
bubbles. And probably there is a fine line in investor behavior. There are assets where there is a suspension of valuation, of traditional valuation methods. There is financial engineering. There is, at this time it's different type of assumption. We have seen it in some new technologies, in some companies. And those are probably the more extreme methods. So, for example, short volatility and XIV is something that we define as one of the most extreme cases, and Bitcoin as well. And we've, from last year, so we've seen a deflation in those prices, in the price of those 2 assets. There are other assets which are overvalued, but probably not a bubble. And again, we look at behavior, which is difficult to quantify.
The fact that it takes a long time for a bubble to burst doesn't mean it's not a bubble. I don't think you could say one is wrong with the other. Mm-hmm. It all goes. What's his name? Go back to Keynes. The market could stay irrational for longer than most people could stay liquid. Mm-hmm. There are definitely assets out there. We could debate which one of them, but there are definitely assets out there which are at valuations which are not sustainable over time. The question is then whether you trade a strategy which is
right.
based on the idea that it's about to immediately revert, or whether you wait until it starts to revert. And that's an investment management choice.
Right.
And I think there is a key the key problem of timing consistency from the point of view of regulators, which, including central bankers, which tend to maximize the short-term health of the economy versus the long-term financial stability. So macroprudential policy is not always a mandate. Financial stability is a secondary mandate of central banks. And in any case, central bankers have often left a very bubbly situation to deal with for their next successors. And also investors, not often they have the patient capital to wait for a bubble to burst. So
however long the investor capital is theoretically, the person running it, if you're running a pension plan and your liabilities are growing at 5% real every year, if you sit in cash for 3 years, you are going to be out of a job after 3 years, right? If you're running an endowment, you're going to have to shut down a university department and you'll be out of a job. And so even if the capital itself is long, that doesn't mean the decision-making periods are that long.
Right. Okay, so we don't have much time left. I would like to touch upon the future of asset management. And in the last few years, there's been a massive development in machine learning, deep learning, big data. And one possible view about that field is a move a little bit away from the theory toward a more data-driven way to approach asset management and investment. Do you think this is going to be the future of asset management, or do you think that there will continue to be a significant role of, the people behind a discretionary touch of asset management? What do you think is going to be the landscape in 10 years from now? Ryan, want to start?
Sure. Okay. So, within fixed income, there still are massive inefficiencies in terms of how the market works. So a lot is still traded over the counter. A lot of, index construction, which the previous speaker spoke about, causes all kinds of distortions. So I think as I look ahead over the next 10 years, there still are going to be lots of things that active fixed income managers at least can take advantage of. Even after the financial crisis, when rating agencies became the most evil things in the world, pension plans, insurance companies, still everybody is obsessed about what does the rating agency rate this bond. And so it creates all these wild opportunities that active investors can take advantage of. Where we try to use machine learning and big data at PIMCO is to try to help us make better predictions about what the future value of assets will be. So a great example would be in the mortgage market, which in the United States, the mortgage market is the biggest bond market almost in the world. And we can now get data on more than 200 million individual mortgages, on 400 million individual house transactions. And then we get crime statistics from the government. We can scrape websites for school ratings. And we can create models that will help us figure out what is the value of this house under different future economic scenarios. And this is analysis that you could never in a million years do by hand. So that then helps us think about what is based on our fundamental economic outlook, what is the likely price path of these assets? And then when we go to buy a bond, are you getting paid relative to the value of that underlying collateral? So that's how we try to use it, rather than being really automated investment decisions.
Luke?
I guess I don't like the either-or choice you gave us. I don't think there's anything in the world where technology is not going to become a bigger and bigger part of what we're doing. There's a man in the front row taking photographs of us. That kit that he's got there is driven by computers in a way that wouldn't have been if he'd used it 10 years ago, and in 10 years' time it will use even more technology in there. Everything we do will involve more technology. There are lots of things you can do, and we do, using machine learning and other quantitative techniques to take advantage of things. That doesn't mean, and there'll be more in the future as there's more data available, as processing power is quicker, but it doesn't mean that there isn't a place for humans. There absolutely is. There is always sorts of information that's not in the price, in the data set, in the whatever.
I guess
one of the great
question...
things, the ability to understand when a CEO doesn't know there's a problem with his business plan.
Right.
That's a very human skill, and one day computers will probably be able to do it. But today, computers are reasonable at judging lies if you give them 10,000 people and they try to get a sense of what proportion are lying. But where people don't know they're lying, computers today have no idea. And that's one of the big places humans are great at identifying something where another human doesn't know they don't know it.
Great, thank you very much. I'd like to open the floor for questions. If you have any questions, can I have the microphone ready?
Okay, thanks very much. The previous speaker, interestingly, was talking about the rise of index funds, passive. So it'd be interesting to see how that's affecting your active businesses. In particular, one point that was mentioned was that fees among active managers might come down in order to compete with the threat of the passives. Is that something that you're grappling with in your own firms?
So interestingly, the place where fees are coming down the quickest is actually in passive. And so Lasse was right that the fees that an active manager charges to the client, I mean, the way I think of it, they're a tax on the returns. If you add value, clients are really quite happy to pay it, but clients won't pay for index returns. I put inverted commas around index. Today, there are order of magnitude 100 times more indices than there are securities in the world, right? So we talk about passive and we talk about index investing. There are literally 100 times more indices that you can invest in than there are securities you can invest in, right? So this idea that you just pick an index and you've sorted your problem out is not really true. But, look, we as an industry have to justify our fees by adding value. And I think over the timescales that humans invest, it's absolutely possible to do that.
I guess the only thing I'd add also in terms of ETFs and how that impacts active management decisions is that, ETFs in most cases have to publish their holdings on a daily basis, and you know which index they've defined to track. And therefore, you know what their shopping list is for bonds or stocks. And so you know what they're going to go after. And you can, in many cases, take advantage of the fact that, like, let's say Ford Auto, they will have 10, 20, 30, 50 bonds outstanding. And if you know only certain ones are in the index, you know that when people want high yield or investment grade, those bonds tend to be the ones that go up in price quicker because you must buy it to replicate the index return. So you can take advantage of that by knowing the rules of how these indexes are constructed and how the passive investors replicate that index.
Please.
Yeah, a question for obviously the panel members. Given the challenges around proving your worth as an active manager, are you seeing a trend, or do you expect to see a trend away from managers being just asked to find, say, the best real estate investment and limit themselves to real estate, towards being asked to actually shape the portfolio between the different investment classes? So do you think actually there's potentially more value there for your sector in terms of giving effectively more sector selection rather than asset selection?
Yeah, so the question is very important. So one of the active investor group sometimes is very broadly defined between people that pick securities and actually people that can do any type of trade. And the reality is that with the compression of yields that we have seen in the fixed income space, or compression of returns in equity, it's become a lot harder for people to overweight or underweight assets within a certain benchmark, within a certain framework, and generate an extra return that justifies fees. In a lot of markets in Europe, post costs, especially retail costs, benchmarked active managers tend to periodically underperform sovereign debt returns over the last 10 years. And the reality is that they're not always really active because they have a very limited amount of choices available. They cannot position for a change of regime in the market. They cannot position for large changes. So in our view, the world will go more towards passive, but also more towards really active strategies where you can take a lot more decisions. One other thing to think about is, what if the world was all made of passive strategies? Passive strategies have grown a lot in the last 10 years. Also, the number of flash crashes has grown a lot. And there is perhaps a risk to the stability of the market if you imagine a world where 90% of the strategies are passive, especially when they hold assets that are illiquid. And we've seen a correlation between these two things. And there is sometimes specific feedback loops that can be identified in passive strategies, especially in the credit market.
I certainly agree that passive strategies in illiquid assets have real challenges. They don't have to, but they do if what you offer. I mean, if you take the classic ETF where you offer the client daily liquidity, but you don't have daily liquidity in the underlying, that's a problem. I personally don't think that flash crashes are caused by passive behavior. The reality, we live in a world where through regulation we've been forced into this uber transparency about transactions. And the reality is always, so I was called into the Bank of England to discuss, it's about 18 months, 2 years ago, there was a correction in the sterling that in the middle of the night went down by, I can't remember, it was 3% or 4%. And they were in a big flap about the fact that this was a flash crash in sterling. The reality is there was a big seller of sterling in Japan. It was a corporate trying to get an execution. They did an execution at a price which 20 years ago would have been just about the same discount. But 20 years ago, a bank would have taken the other side of it. They would have worked the position off over 2 or 3 days. The market would have ended up being somewhere lower than it started, but nobody would have known what level the trade was done at. In the world of uber transparency we live in today, you could see exactly what it was on, and then it's a flash crash. It's not a flash crash, it's somebody wanted to sell a big block of something at the wrong time. If you want to sell a big block of something at the wrong time and you want to sell it in one lump, the price will move a lot. That is true in any asset market.
One more question.
Thank you very much for your debate. And basically, it's a debate about the future of the asset management industry, but it would be a shame to let you go without sharing your views, maybe just briefly, on your outlook for this year, for the present, which is the first year of when we've seen volatility come back, and in terms of maybe the major geographical areas in which you prefer, and in terms of the major asset classes, and even within the credit space, for example, whether it's government bonds or corporate high yield bonds, or could you speak a little bit about that?
Thank you. Let Alberto take this question.
All right. Can I show?
Yeah, go ahead.
One chart. So I think one very quick way to describe what's happening is that it's shown on the right side chart. So we've been in a period where central bankers were worried about the economy. They have created a very nice weather, like today. Like imagine you can change the weather in London and you have 360 days of sun instead of having only 100 days of sun.
We're in London. 10 days will be a winner.
Exactly. But the price to pay is that because no one is carrying umbrellas anymore, then in the 5 days where you have rain, and you have much heavier rain, then you have bigger shocks. So the volatility in the market has become a lot more polarized. And so we are more cautious because we are worried about not so much the fact that there can be economic shocks, but that the recovery is very old, and that sometimes market shocks and positioning can reflect negatively on the economy itself, as it happened in Q1. We had a return of volatility triggered by a very small positive inflation number, but positioning was very, very relaxed on many carry trades. So the recovery is very old. We are worried about the US credit cycle. We're more cautious. We think that the world cannot live with much higher interest rates because the stock of debt imbalance is very large. So sovereigns cannot fund, the US cannot fund at 4%, Italy cannot fund at 4%. So we are in a sideways market with a rise in geopolitical risk, in oil, in the defense sector, and I would say muted performance in the credit market, muted performance in the equity market. So it's one of those years where investors have a fatter tail and lower expected return.
Okay, well, thank you very much. I'd like to thank the speakers for a wonderful discussion.